Maybe at some point SpaceX should become a public company.
I think it's going to happen in the
new year.
Happen. Biggest ever?
Yeah, I think so.
$800 billion valuation today.
Yes.
Man, what does that make you think about when you think about a name and a valuation and a raise that big?
It's big, and I think it's one that everyone's been waiting for because this is one of the top 5 most valuable private companies.
We're all hearing the same headlines, but in all the media coverage, my one big question has not been answered. My question started when a good friend of mine texted our group chat something along the lines of, "I might have been a millionaire if I had gotten a job there 2 years ago." This sounded crazy, but was it? Could he have been a millionaire by 25 by having his first job be the high upside SpaceX? This sparked the big question. What does the potential IPO of SpaceX in 2026 mean for its employees? Especially the ones who didn't get in early, the recent grads, the entry-level engineers who took a SpaceX job with greater equity and less compensation relative to a FANG opportunity like Google. I had a rough sense of the comp packages from my friends who work there, but what surprised me was how the sharpest engineers and minds I know had no clue how to value the equity that they were given. What I learned in digging into this question was not at all what I expected. By the end of this video, you will know 3 things. 1, why the SpaceX IPO is different from a typical IPO. 2, what are the range of outcomes for SpaceX employees? And 3, most importantly, what are the key things to think about when offered equity at any company? And it's not just, is this company going to succeed? It's much more nuanced than that. My name is Cole. I studied philosophy and computer science at UCLA, and I now work as a strategy consultant at BCG. This is my passion project channel where I distill insights from mentors or my own personal research unrelated to my work. And I am not a financial advisor. This is not investment advice. However, this should sharpen someone's thinking when discussing equity or stock. Now, let's start with why the potential SpaceX IPO is different from any IPO we've seen before. Most IPOs follow a typical pattern of the company grows, it raises venture capital, it goes public, and the stock becomes liquid for its employees. SpaceX does not fit that pattern. It stayed private for over 20 years. Not because it couldn't go public, it deliberately avoided public markets. Public markets optimize for quarterly predictability, short-term margins, and clean narratives. SpaceX is building rockets, satellites, and space infrastructure that compounds over decades. So instead of IPOing early, it raised massive private rounds. And along the way, it ran internal liquidity events. Internal liquidity events are scenarios where employees can sell their shares either back to the company or to select private buyers. So, for many SpaceX employees, the IPO actually wouldn't be the first liquidity event, but it is the loudest one, the most visible, and the one that applies to every single employee regardless of tenure. Because of how long SpaceX has been private, the IPO already prices in a lot of its success. Starlink works, it's cash flow positive. Rockets have been proved reusable, and each year, credible use cases emerge for space infrastructure. The existential risk of the company has been largely gone for the last couple years. So unlike a typical IPO where employees are finally realizing upside, this one more so formalizes that upside. But companies do not go public just for liquidity. They go public to raise far more capital than what they could raise in private rounds. SpaceX has reached a point where its ambitions outpace even the deepest private market pockets. Their next phase of scaling requires tens of billions to be dispersed across the company. And finally, SpaceX has a business unit that the public markets truly know how to value. Layer on the reality that this is an Elon Musk company and has the engineering credibility of the likes of Palantir, and you get something that public investors tend to lean into aggressively. That's why valuation speculation runs hot. Not because the upside is undiscovered, but because business units like Starlink give public investors an idea of how to value a company like SpaceX and confidence that SpaceX can solve the other problems that it's trying to tackle. If this has been interesting so far, it would be so wonderful if you hit that like and subscribe button. I'm a monkey talking to a screen and rather confused oftentimes why I'm doing so any positive reinforcement means the world. Now let's get into the big question. What are the outcomes for SpaceX employees? Could someone have been a millionaire by 25 by joining SpaceX at the right time? The honest answer, before I dive deep into the numbers, is it depends, and it is possible. Let's walk through 3 rough cohorts with strong illustrative estimates. Case A, a very early hire. We're talking pre-2017, and they stayed long-term. Imagine a solid individual contributor, not the CTO, just a strong engineer that SpaceX would have hired a decade ago. This cohort joined when SpaceX had serious existential risk. At this time, valuations for SpaceX were in the single-digit billions, rocket reusability was not yet proven, Starlink was speculative, and failure was a very real possibility, not just a talking point. They would have received most of their equity in the form of options, which I will explain more about later, with very low strike prices and very large-looking grants because the risk was very real. After dilution, a long-tenured, solid contributor might realistically land around 0.001% to 0.0025% of ownership. And at a $1 trillion valuation, which many see as a very realistic scenario for a SpaceX IPO, that ownership stake could translate to between $10 million to $25 million. But this payout is for joining before there was proof, when there was serious existential risk, and surviving for almost a decade, one of the most intense engineering environments. Let's talk about Case B. These people joined 5 to 7 years ago, between 2017 and 2019. This group joined after SpaceX clearly worked and had a valuation greater than $20 billion, but before success felt inevitable. Reusability was proven, launch cadence was scaling, and Starlink was moving toward real revenue. Their comp packages had higher valuation at grant, smaller percentage grants, a mix of options and RSUs, which again I will delineate later in this video, and they also would have received a refresh grant after 4 to 5 years at the company. They would likely end up with ownership between 0.0006% to 0.0015%. And at a $1 trillion valuation, that comes out to $6 to $15 million pre-tax. And finally, let's talk about my friend's scenario. Case C, someone who joined between 2 to 3 years ago in the years 2022 to 2024. They're an early hire inside a very mature private company. By this point, SpaceX works. It's operationally proven, Starlink revenue is visible, and their valuation largely reflects that success. Their compensation package would include equity quoted in dollars, not ownership, mostly privately held RSUs, and higher option strike prices where applicable. The upside was tied to execution, not discovery. A typical early career package would be 100 to 150K over 4 to 5 years of vesting. Even if the company performs extremely well, and that IPO hits that $1 trillion mark, the realized value pre-tax is between $0.5 million to $3 million. This does assume that the individual does not sell immediately at the point of IPO, but once their full 4-year vesting schedule occurs. As we've talked about, SpaceX is very different from most companies, and I said a lot of terminology there which might have not have been extremely clear for people that are new to vesting, RSUs, and options. In this section, I want to very clearly spell out of how you should think about equity, the tax consequences, and the stuff that I was stunned by when I was doing my research. When you're offered equity, there are 3 questions you should ask. First, what did I actually receive? Let's talk about options versus RSUs. An option means you're able to buy stock later at today's price. Let's say that again. An option is when you can buy a stock later, potentially when it has increased in value, but at today's price, when today's price could be much cheaper. This means that you'll only make money if the company grows. But as that vesting schedule occurs, you have to pay money to buy the shares at today's price. And if the company doesn't grow past today's price, there's no reason to buy. Conversely, an RSU is just, we'll give you this stock later. You don't buy anything. When your stock vests, you just receive the shares, and you pay taxes right away, which typically is the company withholding like 40% of the shares that they initially said that you're going to get. This is analogous to a delayed bonus paid in stock. Another thing I said earlier was a strike price. This only applies to options. So this is the price that you would be able to buy the stock at, even if it had grown to a greater share price. For example, if when you were given the stock option, the share price was $10, and in a year it had grown to $50, you would be able to pay the strike price of $10 to get this $50 share. And vesting is a word that I've been using a lot. Usually, stock and equity comes in the form of a vesting schedule. Most commonly, you don't get any stock until you complete your first year. And after that, it trickles in over time, with vesting typically occurring at 6-month or 12-month intervals. So if you were to leave SpaceX after only 2 years, for example, and your initial comp package spelled out 4 years with $100K invested options, you could only get $50K before you walk out that door in those options. And literally, if you were to say go to Google, you would have to pay SpaceX $50,000 to control that stock before you could leave the company for your next destination. Interestingly, over the last couple years, even before SpaceX anticipated going public, they started giving their employees privately held RSUs. These function just like publicly held RSUs, with essentially stock given at the end of each year. The second question that you should be asking, and these other 2 questions are much quicker, don't worry, is can I sell it and when? Private companies control liquidity. More frequently than IPOs, a liquidity event takes the form of some type of private acquisition. But as mentioned earlier, there can be internal liquidity events that are held by the company, like what SpaceX did. This is key to your understanding, because if you're given hundreds of thousands of dollars in stock, but you have no idea of when you can make it liquid, that stock could actually have no value. And our third question is what survives after taxes? RSUs are taxed as income when they vest. So for example, if you were given $25,000 worth of RSUs, the company typically will withhold what will be taxed. So in that case, that might be $10,000, and then you are given $15,000 in stock. Conversely, options defer taxes, which adds risk and complexity. In that earlier example, for that SpaceX employee who potentially left after 2 years and they need to buy the $50,000 worth of options, or they want to purchase that, they would need $50,000 in liquid cash to be able to purchase that stock. Some people will do this with a loan if they do not have that much cash liquid, and when there is a liquidity event, they will immediately pay off that loan. But again, this is very high risk. And on taxes, say you pay a $25,000 strike price, and those shares later grow to $250,000 in value. That $225,000 gain is usually taxed as ordinary income. This is considered an NSO, or a non-qualified stock option. It's non-qualified because it does not qualify for unique tax treatment. An option that does receive unique or more generous tax treatment is called an ISO. If it is an ISO, which is determined by the company and given typically to leaders who should have special incentives, you have to hold the shares at least 1 year after exercise and 2 years after grant. And if you do, that gain can qualify for long-term capital gains tax instead of ordinary income tax, which could save you 20+% on the gains, assuming you don't trigger the alternative minimum tax, or AMT, along the way. So bringing it back to the original question of if somebody joined SpaceX as their very first job, could they be a millionaire by 25? The answer is yes. If they were part of case A or B, they would likely see $1 million even if they joined at an entry-level role, as long as they let their full equity vest and did not liquidate during any earlier opportunities. For case C, my friend's scenario, it's possible if they joined closer to 2022, especially as a mid-level engineer, and they let their equity fully vest. Again, this assumes that the valuation when they liquidate their equity does not dip below $1 trillion. However, my friend would have been coming in at the most junior level, so likely would be closer to the lower bound of this outcome range. For most people joining SpaceX today, the value is not realized in the equity, but in the skills and the credibility of working at a top engineering company. This channel is basically me trying to make sense of careers, meaning, money, ambition, while recognizing that there's not the cheat codes that a lot of others might try to state, but there are variables that matter a ton. I'll keep trying to break things down that I wish I understood earlier. And if you have a moment, please hit that subscribe button. Lastly, maybe share this with a friend who's also trying to navigate these types of decisions surrounding how the heck they should value equity. Thank you so much for watching.